All right, ladies and gentlemen, welcome back to another episode of the Tech Guys Who Invest podcast. On this episode, we have a lot for you. We have Will Rhind, who's the CEO of GraniteShares, which is an ETF. And for those of you who are not familiar with that, we're going to dive into that. So welcome, Will.
Thank you. Great to be on.
Fantastic. So for our listeners that are new to stocks, can you explain in the simplest terms what is an ETF?
Yeah, no, in the simplest form, it's a fund that is listed on a stock exchange and trades just like a share. So instead of buying a share in a company that you know or love, like Apple, you buy a share in a fund, and that has a ticker code and just can be bought and sold through a regular brokerage account.
Interesting. So to dive in maybe a little bit further, what are some ways it differs from a mutual fund or a stock?
In essence, it is a mutual fund. It's just a mutual fund that is able to be listed and traded on a stock exchange. However, because of that, it does have some key benefits over the traditional mutual fund. I mean, in some respects, you can look at an ETF as being the new technology in the space. The mutual fund is the old technology. The ETF is the new technology. And really, the key benefits that people talk about most, I'd say one, ETFs tend to be lower cost. So that means from a management fee perspective, the cost of ownership tends to be a lot lower. The other benefit is they tend to be more tax efficient than a mutual fund. Obviously, everybody doesn't like paying taxes and certainly wants to pay lower taxes. And so from an ETF perspective, they tend to be more tax efficient than mutual funds. And then the last thing, really, and probably the key thing in terms of the name ETF, the acronym stands for Exchange Traded Fund, is that it's exchange traded. You can buy and sell whenever you want through your ordinary brokerage account. So most people, have investments in individual stocks. Therefore, it's really easy just to add another ticker code and buy and sell an ETF versus a mutual fund, which typically you have to buy, directly from the company. Probably the last thing I'll mention is that ETFs are totally transparent, which means that on a daily basis, you can see exactly what they hold, exactly what stocks, what bonds, if it's a bond fund, but you can see right underneath the hood any day you want, unlike mutual funds, which typically are a lot less transparent. But those are kind of the key differential for investors.
Thank you for breaking that down. I didn't know the differences, so I'm learning something as we're conversing. You mentioned the old tech versus the new tech. Can you elaborate how, I guess, at the highest level, technology is being used in the stock market?
Well, I think there's kind of a couple of axes to that. I mean, I think the first thing is that from a technological perspective, it's more about the trading and access to capital markets that has changed really over the last kind of 20 years. So, just by putting something on the exchange, you're opening up a huge amount of, I think, new kind of potential investors through all of the people who are able to access the exchange. But I think what I kind of really am getting at is that you should think about it like that. It's less of a technology thing in reality, and it's more of I would say a kind of a regulatory or market structure evolution. In other words, what we've got today is a movement where right from the regulator down to, I think, individual investors, people are more keen to see things traded on an exchange and have it be listed, have it be available to buy and sell, rather than this sort of over-the-counter or concept where you buy directly from fund companies.
Interesting. So you mentioned several things in your answer to Kevin's question a minute ago that I'd love to unpack. And you mentioned taxes. And that's definitely one of the big advantages that Kevin and I talk about to investing in real estate. So we're really interested to hear about this from an ETF perspective. Can you talk a little bit about that?
Sure. So the major thing, and I'll try sort of not to get too technical with this, but when I'm talking about the taxes, what I'm really referring to is the majority of ETFs, they don't pay or distribute capital gains to investors. So mutual funds typically do distribute capital gains to investors. And the reason why that happens is within the mutual fund, the main difference is that when people are selling in that fund, it's the fund that's selling the stocks. And so the fund realizes, or that becomes a taxable event, which is shared between the shareholders. Because the ETF is unique in the sense that trading happens outside of the fund, it's able to not realize those same capital gains or those same tax events inside the fund. And therefore, that's a benefit that gets shared with the investors. So the high level thing is most ETFs don't pay capital gains distributions and mutual funds do. But how they do that is how the funds or the trading activity occurs within the fund.
Yeah, makes sense.
Well, thank you for breaking that down. And Adam and I are risk-averse investors. We always try to figure out how we can cover the downside. For people who are new to ETFs, what would you say are the risks involved with buying into an ETF?
Well, first of all, the ETF is really just we call it a wrapper. That's a sort of a buzzword, if you will, for the package that holds the underlying investment. And the reason why I mention that is because you can have kind of pretty much anything you want within the ETF. So if you're just hearing about ETFs for the first time, you can get an ETF on kind of anything. So it could be gold, which is obviously hugely popular right now. It could be large cap US stocks. It could be international stocks. It could be a specific country around the world. It could be bonds. It could be commodities. It could be all sorts of different things. So when we talk about risk, we've got to talk about the risk of the actual underlying strategy or underlying market or underlying investment class that you're investing in. So the ETF itself, the wrapper or the package, is not where the risk lies. The risk lies in whatever that ETF is investing in. So if it's commodities, if it's large cap US stocks, if it's international equities, they will all be risky. I mean, every investment is risky. It's just some investments are more risky than others. And that will be dictated by what it is in the ETF that you're buying.
So an ETF, effectively, to recap, is more of like a vehicle for that investment class.
Exactly right. Okay. Yeah. The ETF is just the vehicle. And then, like you say, if we take, for example, a gold ETF versus a US Treasury bond ETF, they're still ETFs. They're both ETFs, but the underlying investment is very different. One is US Treasuries, another is gold. And so from a risk perspective, they'll have different risk profiles that people should be aware of.
I would love to dive into gold. That is such an interesting topic to me right now. So you mentioned it a couple of times. What are some reasons why somebody might choose a gold ETF over buying physical gold? And can you talk a little bit about how you think about that?
Yeah, sure. So as you may or may not know, but I actually run at GraniteShares, one of the largest gold ETFs in the country. So I've been involved in the gold market for a long time, throughout the financial crisis of 2008 and before that. So have seen the cycles up and down. And obviously, in case you're unaware, gold is at an all-time high. Went through an all-time high a couple of days ago for the first time, reaching the level that we reached in 2011. We briefly reached the 1900 level. So gold is trading above that right now. And some of the main reasons for that are, I think first and the most obvious one is the COVID-19 situation, which in its simplest form creates a huge amount of uncertainty. And gold typically thrives when there's uncertainty in the market, because what uncertainty means from a gold investor's perspective is people are looking for an alternative to stocks and bonds. People are nervous about what's happening in the stock market. They're nervous about the bond market, and they want something that is not correlated, which means it doesn't move in the same direction as the stock market or the bond market. And so that's why people are interested in gold. I think the two other aspects to it at the moment are that you have zero interest rates as a function of COVID, and you have massive amounts of money printing. And both of those things, the zero interest rates, make it more attractive to own gold because the opportunity cost of owning a zero interest bearing asset like gold decrease when there's zero interest rates. And then when you have money printing, people are nervous that that causes inflation, and therefore gold historically has been a inflation hedge. But as regards to the differences between physical gold and gold ETFs, physical gold, typically most people buy physical gold in the form of gold coins. So you can go buy gold coins from a broker. And gold coins are great. Don't get me wrong. Very cool to have, very cool to look at. But an ounce of gold right now, as I just mentioned, is now over $1,900 an ounce. So right now, somewhere in the region of 1930 to 1940 in terms of dollars per ounce. So an ounce of gold and a gold coin is going to cost you just under $2,000 per coin. Now, on top of that, you're going to have to pay a premium for that because you can't buy, or it's very difficult to buy, a coin at what we call the spot price, which is the price you see on your CNBC screen or on your whatever, on your TV, basically. And so typically a markup charge, which can be quite high. It can be, in the region of 5 to 7%, sometimes even higher. So you pay a lot to get that exposure. Now, contrast that to an ETF. The reason why they're really popular is, one, you can just buy it in your portfolio, just the same as any other stock. You just enter the ticker code and you buy it. You buy it at the spot price. So that's the spot price you see on TV. That's the price that you're going to buy, obviously with the bid-offer spread from the market maker. And then lastly, they're kind of a fraction of the price. So with an ETF like our ETF, which is the GraniteShares Gold Trust, we're backed by, or each share is backed by 1/100th of an ounce of gold. So going back to that almost $2,000 an ounce, a share of BAR, which is our gold ETF, would be around $20. So from a cost perspective, it's much more manageable for people to buy $20 versus $2,000, and then you can buy as many or as little of those shares as you want.
Yeah, that's interesting. So I know some gold bugs like Peter Schiff and Jim Rickards and folks like that have been talking about gold going to an all-time high for quite a while now before all of this happened. And they're looking pretty smart right now, I guess. They're saying, though, it's going to go even higher. And, some of these guys are saying it's going to go double what it is now. And they were saying that before it got to where it is. Yeah, I'm really curious what you think about that. And as someone in the industry, what your take on it is.
Yeah, so let's start with the kind of gold price high of 1980. So in 1980, gold peaked around $800 an ounce. And if you put that into today's terms, in other words, you adjust that price for inflation, you get somewhere around $2,500 an ounce. So a lot of people think that that is the kind of the real high for gold, and have been looking for gold to kind of retrace that level, since that time. The nominal high, as we mentioned, was in 2011, where gold reached just about $1,900 an ounce. And so now, obviously, today we see gold trading higher than that level for the first time since 2011. But I want to make it a sort of analogy, and certainly the way that I think about gold and what could happen is that, in 2008, gold really took off after the financial crisis. So the bankruptcy of Lehman Brothers and the wreckage that was caused in the financial crisis, gold took off in that year, was one of the only assets positive for the year 2008. Stock market was down, massively that year. And then in the next 3 years, obviously, from 2008 to 2011, went on to make its at then all-time high. So I think what's interesting about that is it took 3 years for gold to make an all-time high. So it climbed steadily over those years after the financial crisis. If we look at March or end of February, March 2020 as being our equivalent of the financial crisis, it's only taken gold a few months to go from there to its all-time high.
Wow.
And so I think that leads a lot of credence to this idea that gold has a lot longer to run, or a lot further to run from this point onwards. And obviously from 2008 to 2011, gold prices more than doubled in that time. So from here, you could see gold prices, if they've more than doubled, we'd be significantly higher than where we are today.
Right.
The other thing that's different this time around is, in 2008, in that period leading up to 2011, and particularly let's just call it the 6 months or 12 months leading up to the high in 2011, I would go on TV shows, I was on CNBC or Fox or all these kind of financial shows, and the first question they would ask me would be, "Is gold a bubble? Is gold in a bubble?"
Right.
And I have not heard that once this time around. No one is saying to me, "It is crazy that gold is almost $2,000 an ounce." Not one person. And you don't see it on CNBC, you don't see it with the talking heads, you don't see it anywhere. And I think that lends itself to the strength that we're seeing in this particular rally. And people saying, you know what, it does make sense to buy gold right now. I mean, what else can I do? Like if I'm not investing in the gold market, where am I investing in? I'm investing in the stock market. And I'm not saying, well, that's wrong or right, but a lot of people would think that stock prices at this level, there's an argument to say that they're very high given the wreckage that's been caused in the economy. Bond market, interest rates at zero, bond prices are already very high on historical levels. And then you've got the real estate, which you guys are more familiar with than me, but from a pure markets perspective, there's not a lot of other choices. And so from a gold perspective, I think gold is looking pretty good right now.
I love it.
Yeah.
Yeah, I'm thinking about it. I'm like, oh man, I got to buy some gold now. Speaking of that, how much of one's portfolio would you recommend somebody have invested in gold or ETFs, for example?
That's a great question. So let's start with the gold. So I think enough to be relevant is the simplest answer I can give that would be helpful to people. In other words, you'll hear people saying numbers like 1% or 2% of your portfolio in gold. Now, I don't really subscribe to that theory because the numbers mathematically are so small that gold would have to increase so much for that to make a difference to your portfolio. So I think it's got to be, with any investment you make, it has to make a difference to your portfolio, your overall portfolio, overall wealth. And I think for that reason alone, you have to have a decent amount of gold. So let's say somewhere in the 5 to 10% range. But obviously in today's market environment, that could be higher depending on your kind of appetite for risk and your view as to what's going to happen in the economy. So I think we'll start there. With ETFs, I mean, you could obviously have your entire portfolio with ETFs. Many people do that these days. It's become probably the most popular way to invest. There's trillions of dollars invested in the industry. And I think, certainly, I guess as the younger you get, it's almost certainly the case that you're going to have predominantly ETFs and or ETFs and stocks.
Yeah, that's insightful. Will, I hear a lot of wealthy people talk about acquiring gold as more of a hedge and not an investment as you would assets. And I'm kind of wrestling in my own mind with, how to think about how much of gold should be in my portfolio. And as someone who is more in growth mode, they're trying to grow their wealth. It feels like it doesn't make as much sense for it to occupy a large percentage of your portfolio. You should take that money and focus on assets. Do you agree with that?
Yeah, I do. I mean, so just to be clear, I mean, I've never talked about gold in the context of being a kind of get rich quick scheme. So gold should not be viewed through that lens, in my view. Gold is a currency of last resort. It is a risk management tool. It is something that I think should be part of everybody's portfolio. But the reason why I don't say you should have 100% gold or some huge number is precisely what you said, that gold historically has given good returns, returns somewhere between cash and or bonds and equities. But the whole point of gold is it's not designed to be a high growth investment. We just, unfortunately, fortunately, depending on whether you own gold or not right now, we're at a particular time when, gold from a cycle perspective is doing really well because people are very fearful of what's going on in the economy. But, if this was a normal environment, then clearly people would be much more positioned towards growth in their portfolio and be buying more, assets with the expectation of a higher return than gold.
Makes sense.
Yeah, it totally does. And one of the things Kevin and I try and talk about is not following the herd, educating yourself and doing what makes sense for you based on your education. And right now with it in the news, I mean, when I saw gold on the news, I knew it was reaching this fever pitch. And
Yeah.
it kind of tugs at you emotionally. It's not, it's not hard to want to jump on that.
Yeah.
So yeah, I appreciate you clarifying that for us.
Yeah, no problem.
One thing you mentioned, Will, earlier on, you're talking about 0% interest and leverage. And in real estate, as I'm sure you're aware, leverage is a fantastic tool that you can use to buy a property that you don't have all the cash for.
Yep.
In the case of ETFs, how can somebody use leverage to acquire more shares, or if it is even a thing?
Yeah, so it's definitely a thing. Leverage is probably the oldest, concept we have in finance, which is borrowing money effectively.
Right.
And I'd say it probably is used in two ways. The first one I would say is probably less common, but is something that most people will be familiar with, which is because ETFs can be bought and sold just like stocks through a brokerage account. Depending on what sort of brokerage account you own, you can sometimes be eligible for margin. So that means you can borrow money from your broker, and therefore you obtain leverage to buy either more stocks or a higher notional amount of stocks or ETFs. So ETFs work in exactly the same way. They can be margined, and therefore if you're eligible, if you have a margin account, you can borrow money and buy ETFs. The second one, which maybe certainly people listening to this might not be familiar with, is there are actually leveraged ETFs, which mean that you can buy an ETF that has built-in leverage to it. So it can give you, say, 2 times the return of the S&P 500 or all sorts of asset classes and investments. But that's built into an ETF. So again, you're buying and selling just like a regular ETF, but instead of having 1 times the return of the index, you have 2 times. So those are something that people might not be familiar with, but they are a real thing and they're pretty popular.
Yeah, that's really interesting. I didn't know that there were leveraged ETFs.
Yeah, neither did I. I'd heard of margin. Yeah.
Yeah.
So one thing that many real estate investors do is they use a special type of retirement account to buy real estate in, because you can't just buy real estate in the 401k you have at work or in a traditional IRA, but you can often roll money into a self-directed IRA, and from there you can buy that. Can you use a self-directed IRA, solo 401k, or that type of a tool to buy ETFs?
Yeah, sure. So ETFs, again, just think of ETFs as exactly the same as stocks. So
Okay.
whatever retirement plan, whatever particular tax advantaged account that you own, if you can buy stocks in it, you can buy ETFs. And for the most part, that's every account you can do that.
All right. Well, thank you for clarifying that. One thing that Adam talked about this earlier is we recommend people get educated and do your own research. And that's why we provide this information, is ultimately to present people with the opportunity to learn more. If somebody's looking at an ETF and deciding which one they should invest in, let's say, well, you just use gold. What are things that they should be looking for to decide, oh, I want to go with this ETF versus another one?
Well, that's a great question. Okay, so there's probably let's say maybe more easy answer to this and then a somewhat more complicated answer. So like everything in life, I think there's a huge amount of educational materials on the internet.
Right.
Actually, the majority of them, when it comes to investing, are actually, I think, quite helpful. And there are a number of reputable websites. Certainly, I'd recommend for the ETF industry, websites like ETF.com. So literally as it sounds, ETF.com. ETF Trends, they're industry websites. They're not a manufacturer. They're not trying to sell you a product. They're just informational. They're publishers. So people like that, I think, are a really helpful resource for people just to read and learn, get educated. But particularly when it comes to what's the best ETF, again, you're going to see a lot of ranking websites, a lot of lists, things like that, as you would for probably any product. But ultimately, I think it's about understanding the investment itself. And when it comes to gold, certainly our ETF, the GraniteShares Gold Trust is one of the lowest cost ways to get exposure to gold. And if people are really interested, they can look at in terms of what our management fee is versus some of the other ETFs, or where we store our gold versus the others, or is it physically backed? In other words, we own the 100% of the gold backing each share. Other ETFs or other products don't necessarily do that. So I think it's a question of understanding the product you're going to invest in, and then to the extent you're going to look at other products, try and compare and contrast between them.
Excellent. And we'll put those in the show notes for your reference. So Will, I know you've got some thoughts on how people can generate cash flow. I mean, I know that's tough right now with interest rates where they are and dividends being cut. Yeah. Can you talk a little bit about that?
Yeah, so that's sort of a nod to, there are really three parts to our business. So there are three, streams, investment streams that we focus on at GraniteShares. One is what we call real assets, and we've spent a lot of time talking about the most famous of all the real assets, which is gold. But we also offer platinum, which is another alternative to gold, and broad commodities or commodity investing as well. And outside of real assets, relevant to this part, we have income, and then we have disruptive core equity. And on the income side, we have an interesting strategy, which we try and where the aim is to generate a high level of income for investors, precisely for the reasons that you state, that we're now in a zero interest rate environment. And potentially, who knows, but potentially we could go to zero, or below zero, and negative interest rates in the US. And that would be even harder for people to generate income. But we have an income ETF. It's called HIPS, is the ticker code, HIPS. And that acronym stands for High Income Pass-Through Securities. Now, you guys will be familiar with one of the classes of pass-through securities, very commonly known as REITs, or real estate investment trusts.
Right.
So what HIPS does is invest in REITs and three other sectors in the pass-through world. Master limited partnerships, they tend to be entities that own energy infrastructure. Business development companies, they tend to be companies that are primarily lenders to small and middle market businesses. And then closed-end funds, which are another category of fund listed on the market. And what they all have in common is they don't pay corporate tax. So they're entities that distribute almost all of their income to the investor. And we have a strategy that puts those together. And so you get a diversified portfolio. In our case, that's 60 securities, so a mix of those asset classes. And right now generates an income of around about 10%. And that gets paid out monthly. This is a monthly distribution that gets paid for anybody looking to obviously manage cash flow on a monthly basis. So these are all liquid investments. The ETF, you can buy and sell it whenever you want, but the whole idea is to try and generate a level of income that is a lot higher than you'd get from either traditional bonds or cash or other kinds of interest-bearing assets.
Love it.
Interesting.
So let's say from this conversation, somebody listens to this episode and says, wow, I want to learn more. You talked about ETF and ETF trends in reference to figuring out and comparing different ETFs based on the commodity or what they're trading. What are some resources that you can direct people to so that they can learn more about just ETFs, I guess, in general?
Yeah, I mean those two would be the ones I would say. So they're, like I said, they're not trying to sell you a product. They're purely publishers. They're like a Forbes or someone like that, but for the ETF industry specific. So if you want to just get educated on ETFs, the generic concept, different types of ETFs, the players, the funds, etc., those are really good resources. Other than that, obviously, anything specific that you find interesting or may find interesting in terms of what I've said, obviously we are GraniteShares and our website, graniteshares.com. And there are other, reputable companies in the space as well. Some huge names like BlackRock or Vanguard that people probably already know. And then there are a lot of smaller players that also have more innovative or interesting ideas that perhaps it might be an idea or an investment idea you have yourself, but you've never really understood or never really found a way to invest in it. And so you'll find those ETFs as well. If you just typically Google whatever investment theme you're interested in, plus ETF. Something will hopefully pop up.
Excellent.
Awesome.
So, Will, we know you've talked about tech disruption affecting companies. What does that mean? What does tech disruption look like, and how does it affect companies?
So that's the last pillar of what we do. Is we have a large cap equity strategy that really the idea is completely unique. So most people focus on the concept of picking winners, which means that you're trying to identify companies that are going to outperform the market. And that's very difficult to do. So statistically, that's been proven many, many times. That's incredibly difficult.
Yeah.
And so what we try and do is actually focus on companies that we don't think are going to be able to sustain their performance. In other words, or put simply, we try and exclude losers as opposed to picking winners. And we think that it's maybe more important what you leave out of your portfolio than what you put in when it comes to total return. And the lens that we use is we use technological disruption. So we think about technological disruption as a force, probably the most important force which is occurring in financial markets today, certainly probably the largest forward-facing risk for investors. And then we think about applying that to the stock market and saying, okay, what companies do we think are fundamentally disadvantaged? What are companies that are fundamentally advantaged? And we don't want to own those that we think are fundamentally disadvantaged. And so we build a portfolio that excludes those companies that we feel most likely to be disrupted. And that has led to a performance or a fund that has been able to outperform the market, obviously in this very, very difficult time with COVID-19.
I love that.
Yeah.
The idea of seeing that there's a trend that everybody keeps trying to go for and isn't getting, and it's been proven that it's not. It's like, okay, let's apply that lens in the same idea, just in a different way. I love that perspective. That's
creative.
awesome.
Really
So
cool.
we wouldn't be the tech guys who invest if we didn't ask about technology in your world. So we want to know, what is your favorite piece of technology that has kind of disrupted the ETF industry?
Oh, that's a great question. I think from our perspective, I'd say that for the modern asset manager, I think probably the most important thing would be the cloud. And the reason I say that is because with finance, it wasn't that long ago that you had big server racks in offices,
right?
And people would be physically storing all sorts of data in their own offices on physical servers. And that has all largely gone away and has been replaced by the cloud. And certainly, one thing, this is top of mind for me because this is very relevant to how we get into work from home and how we as a company have been able to thrive in this particular environment. So we built our business in the cloud, our company, and from that perspective, it was a seamless transition to the work from home environment. So when COVID struck, we were in many ways, we were already or always a virtual company. We just chose to work in an office because from a cultural perspective, that's what we liked. And that's what we were familiar with coming from, banks and asset managers kind of as our backgrounds. And so from the tech perspective, we already had the technological, platform set up in order for us to work seamlessly in a virtual environment. We just chose to be in the office. So I think that really has sort of hit home in these few months where we've all been working from home and we've been able to operate seamlessly. I think that's been a big change.
Yeah, it's fascinating how that I think resonates with a lot of people who listen to this show. They work in office environments and have been able to make a relatively seamless transition to working from home. And that would have been extremely difficult just a few years ago. So
yeah,
to your point.
And I think about it in terms of the, going back to tech and what's happened in this these last few months. And, what's really, I think, sort of encapsulated for me is there's been, as you know, this huge chasm that's been created in the economy where what we did was basically said, you're either two types, businesses are split into two. You're either in the physical economy, which means that you're reliant on the physical infrastructure people physically interacting with you, or you're a business that lives in the virtual economy, or at least can support your growth, your sales, etc., in the virtual economy. And we shut down the physical side of the ledger. We said, okay, if you're a physical business, you shut down. You can't do business. But if you're a virtual business, or if you're online, that's fine. You can continue to operate. And it's created this massive environment of the haves and have-nots. And for those that I think were purely reliant on the physical side of the economy, they're having to rapidly rethink their business and decide whether that's something that's sustainable, long term. An example I'll give to people is, most people listening to this might not be aware that Dominos Pizza, which is a brand that probably everybody listening to this will understand or will know who they are, were recently admitted to the S&P 500 index, which is the index of the largest companies in the United States. And you might think, well, how has a pizza company been admitted to one of the most prestigious indexes, financial market index in the country? Well, the simple reason is because they got into this virtual game very early and realized that the money wasn't actually in physical pizza restaurants where you have people coming in and sitting down at tables. That's very, there's a lot of frictional cost in there. It's not easy to scale. They got into the online distribution game of pizza early on, and have perfected that, or at least have made vast improvements in that, so that now, in COVID especially, they were perfectly set up to take advantage of this. And this is, on an app, being able to do pizza, the gamification of points. You think of the traditional pizza restaurant as being more like an Amazon fulfillment center, whereby you're putting the order on the app, someone's fulfilling your order in the pizza, and then someone takes it to you. And so I think it's kind of a perfect example of a business that you'd think of as being, purely something that would be a relic of the physical economy, really transitioning themselves or transforming themselves into something, a business that can thrive now in the digital economy.
That is a fantastic example. And in product development circles, particularly software, the Domino's app is used as a reference a lot. It's interesting because they did what you said, and they gamified it, and it's actually a really good user experience. I mean, you can see the status of your pizza, where it is. They personalize it. You kind of get the name of the person who's preparing it. So, I mean, it's pretty revolutionary in its own way.
Yeah.
Interesting. Yeah.
Yeah. So, but I think just a small example of, how the world has changed just so quickly in the last few months, and how you have to have a digital strategy. You have to have a tech strategy. If you don't, I think it's going to be very difficult going forward.
Yeah, agree. Well, Will, this has been fantastic. Thanks so much for coming on the show and educating our users. I think you've just added a ton of value, and we really appreciate your time. Thanks for coming on.
Kevin, Adam, thank you so much for having me. It's been an absolute pleasure.